Hello again, and welcome back to Profit and Sense. Today we're talking about a question that's on a lot of people's minds. Why are interest rates so high right now? Over the last couple of years, central banks around the world have been raising rates aggressively, and it's hitting people everywhere. Higher mortgage payments, more expensive loans, tougher times for businesses. But what's actually going on here? Let's make sense of it in plain English. First, what is an interest rate? It's the cost of borrowing money. When a central bank, like the European Central Bank or the Bank of England, sets its base rate, it's deciding the price that banks pay to borrow money themselves. When the base rate goes up, banks pass those costs to consumers and businesses. So why would central banks deliberately make borrowing more expensive? The main reason is inflation. Inflation is when prices across the economy rise over time, reducing your money's buying power. Central banks usually aim for low and steady inflation, often around 2% a year. But in recent years, inflation surged way above that target. Energy prices spiked, supply chains were disrupted. Labor shortages drove up wages, and after the pandemic, there was a lot of pent-up demand. All of that pushed prices up fast. High inflation is dangerous because it eats away at savings, makes planning harder, and can cause social and economic instability. So central banks have a job: keep inflation under control. One of the main tools they have is raising interest rates. When rates go up, borrowing becomes more expensive. People and businesses tend to borrow and spend less. Demand in the economy cools off as demand drops. The pressure on prices eases, and inflation slows down. It's not an instant fix. Raising rates is a blunt tool. It can take months or even years to see the full impact. It's the standard way central banks try to control inflation. You might be wondering why central banks don't just leave rates low forever to keep things cheap for everyone. The problem is that if they ignore inflation, it can spiral out of control. When people expect prices to keep rising, they demand higher wages to keep up. Businesses raise prices to cover costs. It becomes a self-reinforcing cycle. Breaking that cycle is much harder later on. By raising rates quickly now, central banks hope to avoid even worse pain down the line. Of course, higher interest rates have side effects. Mortgage payments go up. First-time buyers struggle to afford homes. Businesses face higher costs when they want to expand or invest. Governments with large debts see their interest payments increase. It can even push the economy toward a recession. Central banks know this risk. They try to balance slowing inflation without completely killing growth. It's a tricky balancing act. Different countries face different situations too. In some places, inflation is mainly driven by energy costs. In others, it's wage growth or supply bottlenecks. Central banks have to consider their own economies and make tough calls. Another thing to remember is that we got used to ultra-low interest rates for over a decade. After the global financial crisis in 2008, rates were slashed to support growth. Then during the pandemic, rates were cut even further to help people and businesses survive lockdowns and economic shocks. But low rates can't last forever. They encourage borrowing and risk-taking, pushing up house prices and stock markets. When inflation came roaring back, central banks had to act, even if it meant pain for borrowers. The big question now is how high rates will go and how long they'll stay there. Some economists think we're near the peak. Others warn rates might have to stay elevated for a while to really tame inflation. It depends on whether price pressures truly ease and whether economies can handle higher borrowing costs without crashing. So when you hear about interest rates going up, it's not just random cruelty from central banks. It's their main tool to fight inflation and keep the economy stable over the long run. But it's a painful tool, and it hits ordinary people in real ways. Understanding why rates rise helps you make better decisions. If you have a mortgage or are thinking of buying a home, you'll want to know how rate changes affect your payments. If you're investing or running a business, interest rates shape costs and risk. The more you understand about this, the less the headlines will scare or confuse you. If you found this helpful and want to learn more about how money really works without the jargon, please subscribe to Profit and Sense. Thanks for watching, and I'll see you in the next one.